Good evening, ladies and gentlemen. This is Barry Norman on behalf of investing.com and FXTM Forex Time, who's sponsoring our class tonight. FXTM is one of the world's leading Forex providers, having been around in the industry for many years, receiving many awards, and is considered one of the best brands to trade with. Forex Time is regulated, so you know that your trading is safe at all times. And depending on where you're located, they have different regulations, and they fit in all the jurisdictions they offer their services in. They offer very, very nice promotions. They have their loyalty cash back and $4 for every lot you trade, all types of promotions. All you have to do is simply ask, and they'll share it all with you, or you can go to their website at www.fxtm.com, and you'll find one of the most extensive websites in the marketplace. They offer impeccable education. They offer incredible support materials, and everything is upfront and available to you. They also have some of the best live educational webinars and educational videos. If you want to learn how to trade Forex or you're new to the markets, it is one of the great places that you can start your education. They're also now sponsoring that Sahara team, so you can trade with a world-class winner at all times. And they are the sponsor of tonight's class. So remember, give FXTM a shot. They are the global authority in Forex trading. Now, tonight's class is about risk management. And risk is the most important part of trading. Too many traders don't think about the risk. They think about losing their money, but they don't actually understand that you can balance your risk, and that deciding how much risk you can afford per trade, or what risk you're subjected to, or what your possibilities are of losses, can enhance your trading and your success rate. Because a good trader will balance out his risk to profit or profit to loss ratio and determine ahead of time if it's even worth making the trade. And this should all be part of your trading plan. Now, many novice traders begin trading without a trading plan. Trading plan is not a strategy. It incorporates your strategy. A trading plan is a breakdown of every decision you will make before you enter a trade. For instance, if you decide you're only going to trade on Monday, Wednesdays, and Fridays, that's part of your trading plan. So you make sure that plan tells you not to trade on Tuesdays. Or maybe you only want to trade while the European and Asian sessions are open, or only after the Asian sessions. This is part of your trading plan, because these become the rules that you follow. And all of these rules have to be checked off before you actually make a trade. And your trading strategy, what indicators and oscillators, how you're going to make your decision to make a trade, what your entry points are, what your exit points are, all of that is part of your trading plan. Now, strict money management and risk control is essential to achieve long-term success in the markets. The high level of leverage available to traders makes it important to manage risk exposure to avoid over-leveraged positions. And this is what happens. Too many traders get in a trade because they think they're going to make 100 points, but don't realize they're exposing themselves to 400 points of risk. Well, that's not a good trade, because inevitably you're going to end up losing, and you'll lose more than you could have made. So successful money management aims foremost at the preservation of initial trading capital. Now, we're going to look at some tips at how you should set up your money management and your risk management skills. But leverage is one of the deceiving things, one of the great things about trading in Forex, but it can be deceiving. Because even though you're only putting up $1,000, doesn't mean you can only lose $1,000. So you have to understand what your exposure is. So leverage can be defined as the amount of the trading position you can control with any given amount of margin. It is money placed on an account as collateral. Also, the leverage ratio is the ratio of the amount of leverage to the amount of margin. In practice, a leverage ratio of 50 to 1 means that you could control $50,000 worth of a position with just $1,000 on deposit. So you have the possibility of losing that $50,000. Now, granted, Forex currencies or commodities don't move in that great of a realm. You know, even when the markets get very volatile and you hear that the euro lost 200 points today, that really isn't much. If you had a $50,000 position and it lost 200 points, you would be out of your pocket probably your $1,000. But it's important to understand what risk you're taking when you enter a trade. While professional Forex traders generally trade using the credit lines that banks or their counterparties extend to them, retail Forex traders have to master this concept of leverage since they are usually required to trade on margin rather than credit. Naturally, this high leverage ratio can act as a two-edged sword since losses can accumulate as quickly as profits on larger positions. Nevertheless, if you are accurately called the direction of the market, you stand to make good money on your rather small investment. So leverage is a great tool, but it has to be a tool that you use safely. It's like would you use a saw without the protection? Would you use a saw when a child is around? Would you put your thumbs close to the saw blade? No, because you always want to manage your risk. You don't want to ever expose your thumb to that saw blade. Furthermore, traders need to keep close track of their margin requirements for open Forex positions, since many retail Forex brokers will simply close out losing positions when a situation arises where margin in the trading account has been used up due to adverse market movements. And this is something that affects small traders and novice traders because you don't have enough funds in your account except to cover the bare margin, and you have too many trades going on simultaneously. And you need to constantly monitor everything that is happening. And many new traders tend to only see the profit and they don't see the loss, but what they also don't see is how much loss they're exposed to. So they set their stop losses way too close. So they could be completely right, but they get stopped out of the market because they couldn't predict the right volatility or swing in the marketplace. So their winning trades end up as losing trades. Now, one of the most important things is if you can build a trading plan and incorporate your risk management and your money management inside your trading plan, you'll find that you'll be able to adopt and maintain a neutral trading style. That means being detached, getting your emotions out of the market, okay, not getting excited because you're following the rules of your trade. The excitement of real-time trading and the thrill of seeing an investment rise or fall can sway anyone. And believe me, I've been trading for 40 years and I still get overly excited. Okay. You know, you tend to let your emotions, your excitement, your adrenaline either make you compound trades, or you forget to move up your stop loss, or you let your trade ride too long because you stop following the plan of your trade that incorporated all of your risk management and your money management skills. If you expect an asset to go up 100 points and it's going up, do you want to ride it to 125? No. You take your take profit where you set in your trading plan. Now, a trading plan can be adjusted, not in your trade. You can sit down and decide, yes, well, maybe this report came out much better than expected. So the euro will rise more than I had predicted. So I will let my trade run, but you make a solid decision. You don't let your emotions sway you. Staying attached or objective about an investment while keeping emotions in check allows for the clear thinking required to make appropriate trading decisions. Keeping a neutral outlook as trading occurs allows the larger picture to be evident and ensures that the planned trading style is fulfilled without being biased by temporary changes. So some of your guides for part of your risk management should incorporate things like, when losing in trade after trade, lower your trading side by 50%. Cut back your risk, cut back the size, cut back your lot. If you're trading 100,000 euros at a time, cut back to 50. Go even smaller if you need, because you need to wait till either you've adjusted or fixed your strategy, or the market volatility is eased out, or sometimes you need to be able to stay in the markets long enough to realize that this trading strategy or this indicator and oscillator aren't working in the new as well as you expected in the current market situation. And you can then adapt a new strategy to your next trades. But if you don't cut your trades back smaller, you'll find you've lost all your funds, or you've lost so much that you start chasing it. So the best thing to do is, when you start having a few losing trades, cut back the size of your trades right away. Remember, if you're a new trader, you should only risk about 1% of your capital per trade. While this is standard, you must avoid the temptation to trade big to make up losses. And believe me, everybody wants to make up losses. You start trying to chase your losses. And believe me, in 1982 and 83, I was making money hand over fist. 1984, I was going broke. And I couldn't make a good trade in 1984. And what happened was, I stopped using good money management skills because I was chasing my losses, because I was a day trader and making my living out of trading. And I needed that income each month to pay my bills. So if I didn't make the money, I didn't have the money to pay the bills. So I started chasing trades. By the end of 84, I was dead broke. Okay. So you want to avoid the temptation to chase your losses. This usually compounds the problem because the market is not cooperative with your style during a downtrend. 3, stay disciplined when you're with your entries and exits. Do not get sloppy. This means, don't say, okay, I think gold's going to go up to 1250 today. So, maybe I'll set my stop loss at 1247. You know what? Maybe I'll do it at 1245. No. Figure out what your risk management is, what your money management skills are. Figure out the swing in the marketplace, and figure out exactly where you should have your stop loss. Exactly what the swing of the marketplace. Don't get sloppy. Don't get lazy. Don't overestimate. Don't just say, I'll set it here because I think it's all right. And do not abandon your method. Some traders have this plan, and their plan works great, and then when their plan stops working, they just abandon it. They start throwing bits and pieces out. A trading strategy is not part of your method. Trading strategies change all the time because market conditions change. But when you build your trading plan, your trading strategy is in, and you could be using, I have this strategy for volatile markets, this strategy for the Federal Reserve meeting, this strategy for the ECB meeting, this strategy for when this has happened, this strategy, okay, this is part of your trading plan. You can adjust your strategies all the time. You can adjust the indicators and oscillators and how you're using them all the time. But don't abandon the method you're using. And do not take losses personally. I see more people in the pub at night, my Forex buddies and my CFD buddy, pissed off, madder than hell because they had some bad trades. Okay, what happens is when you get upset like that, you stop making good decisions. It's not your fault the market wasn't conducive to profits. Now, somebody told me a million years ago, a long, long time ago, that when you trade, you should figure that you're going to have 6 losing trades for every 4 profitable trades. Okay. Now, that could be right or wrong. I used it as a rule of thumb. And as long as you're making enough profit in your profitable trades, you don't care about your losing trades. You know you're going to have losing trades. So if you say you're going to have 6 losing trades to every 4 profitable ones, Well, you just want to get 3 or 6 so you get to those 4 profitable ones without getting upset. Just move on forward. And do not fall into the temptation to let losers run. That's the worst thing is, I'm sure the market's going to do exactly what I expect. I'm sure the market's going to turn around. I'm sure the euro is going to reach 112 today. Cut your losses at predetermined stops, regardless of the pain. Do not chase the markets. And do not stop tracking your watch list for the markets you trade. Be ready to take the right entries when it presents itself. Don't force trades. For instance, I only traded agriculturals. Okay. But when things were going bad in 84, I started trading precious metals. I started trading all types of other commodities. And I didn't even understand. Not that I wasn't an expert on those. I was an expert on agriculturals. Okay. You can't be an expert on all the assets out there. You should have part of your trading plans are only the assets you're willing to trade. Okay. And don't let yourself get beat up over a string of losses. And don't go out there. You have to be ready to jump back on the boat when it's ready to sail again. But just don't drown while you're waiting for it. Okay. Sometimes maybe you should leave the market for a week or for a day. Skip a day of trading. Okay. Let the things just move around you. But always, always be in control. Okay. Paul Tudor Jones is a very well-known trader and investor. I got this quote from him, and I thought it summed it up really well. Where you always want to be in control, never wishing, always trading it, always first and foremost protecting your ass. That's why most people lose money as individual investors or traders, because they're not focusing on losing money. Okay. When you focus on profit as opposed to possible losses, you get all messed up. They need to focus on the money that they have at risk and how much capital is at risk in any single investment they have. If everyone spent 90% of their time on that and not 90% of the time on the pie in the sky ideas of how much money they're going to make, then they'll be incredibly successful traders. Now, online trading is set up as a rather risky endeavor. Okay. I always encourage new traders to go easy on the risk as they get started. This system is somewhat rigged to encourage risky behavior. It's like anything else. When somebody offers you a big thing for a little cost, you get yourself suckered in. They're not trying to sucker you in. Nobody's trying to sucker you. It's like when you get your first credit card in the mail and you get this credit card in the mail, it's got a $5,000 limit on it. You go out and spend it all. You got new suits, new clothes, new everything, new dishwasher, because you don't stop and think you're going to have to pay it back. Because credit cards do the same thing as when you have this big spending power put in front of you, sometimes we go hog wild. Now, if you're smart and you manage your credit card bills and you manage how much you spend on the credit cards or how much your wives and kids spend on the credit card, you do all right. Well, you shouldn't be the same thing in trading. The number one thing that you can do is manage your risk, is to never trade money that you can't afford to lose. Sometimes people skip the one thinking that won't happen to me, but it really will affect your trading performance. Like I told you, in 84, when I needed to cover my bills with my profits, I got riskier and riskier. When you need to make the profit, when the money you're trading with isn't your investment money, your extra money, you're free to whenever you make profit on money, you let this overshadow your decision-making process and you make wrong decisions. If you're trading money you can't afford to lose and you lose significantly or even face the threat of losing significantly, your decision-making will be compromised and mistakes will happen. The second important thing is that you need not let your eyes be too big for your stomach. And this is a big problem in the markets. If you don't know what this means, it means start small. Make your trade sizes appropriate for your account balance. Now, U.S. brokers and now most European brokers are only offering trades of 50 to 1. Now, when we talk about leverage, I'm talking to an international audience here. And leverage, the maximum leverage is set by the regulator in your country. So when we're talking to 50-1, the new FCA regulations are 50-1. Each country and each regulator has a different maximum. So you can see what the maximum is on your, when you log in based on where your home country is and what the regulator is. Okay. But that doesn't necessarily mean you need to be thinking of, you don't need to use all the leverage that's available for you. Trade what you are safe and able to trade. This means you shouldn't be opening $100,000 trades with a $2,000 account. This is no need to make huge percentages every day on your money because it's not going to happen. It's more important to make continuous percentages rather than large ones. Okay. Look, if you got $10,000 in your account and you start, before you open your account, you say, okay, at the end of the year, I'll be very happy if I have $15,000 in my account. That means you made a 50% profit. Okay. Well, you're not going to make that on one trade. If you can make a little bit of profit on every trade, at the end of the year, you end up with a lot of money. Okay. So you say, I have a couple losing and a couple winning, and each week I want to end up with $500 in profit. At the end of the year, you end up with what? $500 a month, $500 a week, 52 weeks, that's $25,000 profit. That's not a bad way of going. Okay, it's when you're going to try to make $5,000 a week in profit. So a stop loss is the most important risk management tool you have. A stop loss is a type of order that does exactly what it says. It stops you from losing any further money from your account. Trades don't always go the way you expect. You need a parachute to cut your losses. The trick, though, is to set your stop loss in a spot that you know the trade will reach if you are totally wrong with your trading idea. Your stop loss is not to be put where it maxes out what you can afford to lose. You need to figure out where the stop loss should be put based on the swing of the marketplace and where you wouldn't get stopped out if you're trading. And then you have to then decide, could I make this trade? Because could I cover the market volatility if the market goes all the way down to where I need to put the stop loss to cover the swings in the marketplace? Not when you place your stop loss at only what you can afford to lose. So in other words, if you think that you can only afford to lose $1,000 and you put your stop loss at whatever it happens to be, say 10 pips down or 20 pips down, and you don't look that the market dips 10 and 20 pips all day long, whether you're right or wrong, you shouldn't have been in that trade because you couldn't cover the swing of the market. Now, stop losses should be considered to be your emergency exit. They should be set to execute when your trade has gone horribly, horribly wrong. I've seen many traders place their stops at a price where they might be wrong, or even worse, could possibly be wrong. If you set your stops too close to your price, it's going to get hit. It's Murphy's Law. Okay, so while managing losses is paramount to a Forex trader, another key way to keep trading risk at manageable levels consists of recognizing when a profitable trade has run its course. This third risk management concept involves using a trailing stop. Okay, this means that as the asset moves in your favor, you can keep moving that stop up continuously. And hopefully that stop will be above your profit levels. And at that point, you've now locked in profit. And then you can let that trade ride because you can keep moving that trailing stop loss up. Moving the stop even further towards the present spot rate will further protect gains once the trade becomes even more profitable. In addition, trailing stops allow you to follow trends as they unfold for maximum profitability. Now, trading with money that you can afford to lose, in the worst case scenario, trading with reasonable lot sizes and controlling your risk with stops will prevent you from having a major trading disaster. And this is what we're all wanting to protect all the time. We don't want to see most of our investment money wiped out, because if you can't ride out the markets, then you'll eventually lose. You need to be able to ride out those 6 losing trades for those 4 profitable trades. And you need to be able to ride out blips in the market and unexpected volatility. Far too many traders take the Wild West approach to trading, and sometimes it works for a while, but when it's over, it's really over. They tend to walk away with empty accounts. And then they want to blame it on the brokers. But it's not the broker's fault. The brokers are there to help you. They're there to explain to you, but they can't do your risk management. We're going to try to tell you what it should be and where it should be, but we can't help you or determine for you what is right for you. Speculating as a trader is not gambling. The difference between gambling and speculating is risk management. In other words, when speculating, you have some kind of control over your risk, whereas in gambling, you don't. Even a card player, such as poker, can be played with either the mindset of a gambler or with the mindset of a speculator, usually with totally different outcomes. So the other tool that you have is your take profit orders. Take profit is part of your trading plan. At what point will you be happy exiting the market with the profit? You can set your take profit points to automatically be triggered. Okay? And this becomes very, very important because you don't get overconfident in the markets. You take what is necessary or what you had predetermined. Now, there are many different strategies out there for protecting risk, and we're going to talk about a couple different ones here. So one of the biggest and most popular ones amongst retail traders, especially new traders, is called Martingale. Martingale became very popular with the growth of retail online investing. Then we have anti-Martingale, and then we have purely speculative. Speculation comes from the Latin word specularati, meaning to spy out or look forward. Now, Martingale, which is very popular with new traders, I don't know, I get so many calls from people saying, I like to use Martingale. I follow the Martingales. Well, I find most of Martingale is absurd. But in a Martingale strategy, you would double up your bet each time you lose and hope that eventually the losing streak will end and you will make a favorable bet, thereby recovering all your losses and even making a small profit. This is the most insane strategy I've ever heard of, but a lot of traders follow it. Okay, it makes no sense to me. When you're losing, I wouldn't double down, double down, double down. That's great for cards. It isn't great for investing. Now, Martingale was developed in the 18th century France, way before there was investing, and has its roots in mathematical and scientific development of the enlightened area. The Martingale strategy involves increasing bet sizes for every losing coin toss. When the trader bets that the amount X that the currency will go up by P1 and his bet fails, he will simply double that amount. But the fact is, that's fine if you have endless money to double it up. Most people end up broke before it ever turns around to that lucky trade. So you'll hear a lot of people talking about martingales, but you also hear a lot of people talking anti-martingales. Using an anti-martingale strategy, you would halve your bets each time you lose. To me, this makes a lot more sense, but would double your bets each time you won. This theory assumes that you can capitalize on winning streaks and profitable accordingly. And this works because, okay, as the markets move against you, as the markets change, as the volatility levels change, as things change in the market, you're cutting back and you're cutting back your risk until the markets move in your favor. When the strategy that you've developed is working well, it tends to work steadily until it crashes. Well, when you see it's working good and you have the euro-US dollar down pat, and whatever you're doing for the euro is also working great against the pound, against the yen, you can keep increasing your size of your trades steadily across the board. And then when one of them goes the opposite direction and you start losing, you cut back your trades by 50%. So clearly for online traders, this is the better of the two strategies to adopt. It is always less risky to trade your losses quickly and add increases to your trade size when you are winning. However, no trade should be taken without first stacking the odds in your favor. And if this is not clearly possible, then no trade should be taken at all. And this is one of the most difficult trading strategies there is, or trading plans. And that is making no trade. You always have three choices: to go long, to go short, or not to trade. Okay. When you can't stack the odds in your favor, that means that your risk-reward ratio is not wide enough. Okay. You should not trade. Now, how do you know when it is wide enough? Okay. Well, a lot of us base it on a couple rules. So first, let's remember the 2% rule. 2% or more per trade is highly recommended guide for everyone to follow. We stress guideline because it depends on other factors besides your experience, like your trading systems, mainly how often you trade and how many open trades you have. The more currency trades you take per time frame that you focus on, the less you want to risk per trade. But your rule should be never more than 2%. And if you're a newbie trader, never more than 1% of the capital that you have in your account. So if you have $2,000, you should only be trading with $1,000. Okay. You want to always balance risk and reward. Another way to increase your chance of profitability is to trade when you have a potential to make 3 times, and this is crucially important, 3 times more than you are risking. If you give yourself a 3-to-1 reward to risk ratio, you have a significantly greater chance of ending up profitable in the long run. Okay. Too many traders don't weigh the risk to reward ratio. And the higher you set it, if you set it more than 3-to-1, you'll get very few trades. A lot of traders will say, I'll trade 1-to-1 or 2-to-1. 3-to-1 is your best scenario, okay, because you need to have 3 times more profit than you have potential losses. So limit your investment. Okay. Now, if you are using an investment that pays 3-to-1, okay, and you have so many winning trades, at least each one of those trades paid you $3,000 on every $1,000 you were risking. Where if you're using a 1-to-1, you were only getting up to $1,000 for every risk you had. So in the long run, you would trade less with the 3-to-1 ratio, but those trades would pay higher payouts. Okay. Now, it doesn't mean if you were trading 1-to-1, the asset went up 3. But the thing is, when you're setting your take profit and your stop losses based on your risk and reward ratio, even though that asset went up $3,000, if you're using a 1-to-1 ratio, you already paced your stop too close. You're taking too many riskier trades. And then this is the big one. Start large reward to risk ratios, okay, come at a price. On the very surface, the concept of putting a high reward to risk ratio sounds good, but think about how it applies to actual trading scenarios. So let's say you're a scalper and you only wish to risk 3 pips. Using a 3-to-1 reward to risk ratio, this means you need to get 9 pips. Right off the bat, the odds are against you because you have to cover the spread. A 3-to-1 ratio is about the best you can do. Now, if your broker offers a 2% spread, you'll have to gain 11 pips to cover that 3-to-1 ratio, forcing you to take the difficult. Okay, and if you wanted to take the 4-to-1 ratio, that puts you way out there because at 4-to-1 ratio, you're going to be taking 8 plus to 2 is a huge risk, and the chance of you ever getting a trade in at a 4-to-1 ratio will be very unusual. So a 3-to-1 ratio is about the best you're going to find. And if you go to 2-to-1 you can have exceptions to your rules, but these exceptions are written in your trading plan. If you were to reduce your position size, then you could widen the stop to maintain your desired risk reward ratio. So again, you could do this by what? Trading smaller, using smaller leverage or smaller lots, which will allow you to take larger scenarios. In the real world, reward to risk ratios aren't set in stone. They must be adjusted depending on time frame, trading environment, and your entry and exit points. A position trade could have a reward to risk ratio as high as 10 to 1, while a scalper could go as little as 0.7 to 1. Now, if you build your trade in your trading plan, okay, and forget your risk reward ratio, because too many people want to adjust their trading plan to fit their risk reward ratio. It's backwards. What you do is you build your trading plan, then you look at the asset. Okay, you say where you can put your stop loss, where you can put your take profit on the proper markets. Then you go back to your risk reward and at your account size and decide, does this fit into my trading scenario to make that plan? Because a lot of times you say, oh, look at that. The euro should go up 100 points when this happens, but it could fall as much as 200 points. You've done that analysis. It doesn't matter how much money you have in your account at that point. I'm not making that trade. Or the euro is going to go up, possibly go up 30 pips today, but I've got to risk 40 pips to let it go up 30. I'm not going to make that trade. So you've already factored that in. So in conclusion, risk is inherent in every trade you take. But as long as you measure risk, you can manage it. Just don't overlook the fact that risk can be magnified by using too much leverage in respect to your trading capital, as well as being magnified by the lack of liquidity in the markets. When a disciplined approach and a good trading habits taking on some risk is the only way to generate good rewards. So risk is not a bad thing as long as you know what it is. Now, some famous quotes on risk from Warren Buffett is, risk comes from not knowing what you're doing. That's more important. Price is what you pay, value is what you get. Sometimes sitting in the shade today because someone planted a tree a long time ago, and you only find out who is swimming naked when the tide goes out. So remember, understand what risk you're taking. Risk is personal. Risk is based on your account size, your experience, and what you've determined for the trade. But your risk to reward ratio should be at around 3 to 1 on the average. If you're a newbie trader, you shouldn't be risking more than 1% of your capital per trade. If you're an experienced trader, 2% is the acceptable rule. So if you keep these factors in mind and you actually build yourself a trading plan, and look, I've been trading for 40 years now, and I actually have my trading plan written down. My trading plan is photocopied, a blank, and I fill in every line of my trading plan, and I have books and binders behind my desk with every trade I've ever made and every plan that I've ever used. Now, today, everybody uses computers to do all this. I still do it old-fashioned by hand way because I have them sitting on my desk and I tear them off as I'm looking to trade because it makes me check off the lines and makes me make sure that I follow every rule that I've laid out. And if you're not sure how to build a trading plan, we have a whole class on building a trading plan. And we'll give you a general outline in that class because building a trading plan is very, very important. So if you want to learn more about building a trading plan, join us for our class, How to Build a Trading Plan. And on that note, I'm going to say goodnight to everybody. Again, go to www.fxtm.com. And if you go over to the education, click on their webinars or their education. If you go over just to education and look down under education and look down for trading plans, they have a generic one set up for you that you can follow along, or look under their webinar section, sign up for the webinars that are coming up and learn with their webinars. So again, go to www.fxtm.com. So thank you very much for joining us, and thank you for supporting FXTM. Thank you for listening to me tonight, and thank you for being part of investing.com. Have a good night now, and we'll talk to you again real soon. Bye.